So now tell me, what do you understand about project or investment appraisal? Like, tell me your idea about project appraisal. What do you understand about that chapter?
Mm, so is it like calculating like what to say?
Calculating?
Yeah, it's like, is it like calculating the inflows, outflows of the business, and like like assuming the positions of the business?
Meaning the commissions of the business.
No, the positions of the business, like
Yeah.
on where they stand basically.
Yeah, so based on on their investment, whether the investment is successful or whether the investment is not profitable, like that, they can evaluate using IRR, using NPV, using payback period method, using average rate of return method. So they can calculate those values, and they can evaluate a project whether they should continue with that project or whether they should close that project. Did you understand?
Yeah, understand.
Okay, so when calculating NPV, okay, so we must take only cash inflows and outflows. Okay, when calculating NPV, that is net present value, we should not take depreciation. Okay, because um, depreciation does not involve any cash movement. So when calculating net present value, we take cash inflows and cash outflows. Depreciation, we have to ignore that. Did you understand that?
Yeah, I understood that.
Okay. So IRR means, okay, so each method NPV, I'll do a question. Okay, so when I'm doing the question, you will understand. So for now, roughly I'll teach all those methods. Okay, so IRR means, IRR is the internal rate of return. Okay, it has an equation. So when they give a question, you have to put that equation and find. Okay, so when doing past paper questions, I'll explain that. Okay, so now look at the equation that I gave you. Okay, so capital P. Are you looking at the equation?
Yeah, I'm looking at it.
Okay. So capital P is the rate giving a positive net present value. So when there's a positive net present value, you have to put near that P. Okay. Or we can take a smaller percentage value. Let's say 8% and 10%. So 8% is smaller, right? So you have to put it there. Did you understand like that?
Yeah, understood.
Okay, N means N, capital N. That is the rate giving a negative net present value. So minus. So if it has a value like that, you can put near N, capital N. And simple P, that is positive net present value. So capital P and capital N is the rate, okay? But simple P and simple N is the positive net present value plus 32,333 like that. So N, simple N means it's the negative net present value. So if you get a negative value, you can put near N. So you have to substitute every values in that equation, and then you have to find the IRR value. Did you understand that?
Yeah, I understood that.
Okay, so first equation is when the NPV is a negative and a positive figure, but the second equation is when the NPV is a positive. Okay, so you have to memorize these equations. Okay, and then payback period. In that method, depreciation must not be taken. Okay, so even in IRR, depreciation must not be taken. But in average rate of return, we take depreciation. Okay, because we are calculating the profit. So definitely we have to take depreciation when calculating ARR. Did you understand that?
Yeah, understood that.
Okay, so ARR, let's go to ARR. So ARR is the accounting rate of return, or we can say average rate of return. Okay, so depreciation must not be taken, and then interest cost must also be taken. So when calculating ARR, we have to take interest costs also. If they give, then we have to take. Okay, and then the accounting rate of return expresses average profit from the investment as a percentage of the average of the capital investment. So ARR ARR helps a company to find whether they are profitable or not. It will help the company to compare its profitability. Okay, so ARR, how to calculate that is average profit divided by average investment into 100. So if you want to find just profit, then it's income minus cost. Okay, but then if you want to find average profit, then it's total profit divided by the number of years. Okay, so let's say your project is carried out for 5 years. Okay, so number of years will be 5. Did you understand? Like that you have to calculate.
Okay.
Okay, do you have any doubts?
Not yet.
Okay, so average profit is the average of the incremental profit. So overall profit, you have to take the average. So average profit, like I told, you have to calculate total profit divided by number of investment. So okay, so average investment, how to calculate average investment is the total cost of the asset acquired. That means the cost of the project divided by 2. So you have to divide that answer by 2. Then you will get the value for average investment, and then you have to separately find both and then put it to the ARR equation and find the value. Did you understand that?
Yeah, understood that.
Okay. So now how to compare two projects in ARR? So um, let's say the ARR value is 23.75%. Okay. So you can say Baggins Limited is able to compare 23.75% with the rate of return that it expects to earn on capital. Okay, to decide whether the project will be worthwhile. So it can compare that 23.75 with the rate of return that it expects to earn. So let's say the rate of return that they are expecting to earn is 30%. No, let's say they are expecting to earn 20%. Okay. Now this value is 23.75, right? So it's greater. So we can compare both and decide whether the project is worthwhile or not. Did you understand?
Yeah, understood.
Okay. If it is currently earning a return on capital employed, ROCE of less than 23.75. So now the ARR is 23.75. If it's earning less than that value, then the project should improve its overall profitability. Okay. So you can say like that. If the present ROCE is more than 23.75, so if the ROCE is more than 23.75, then the project will dilute its profits. Okay. So ARR more than ROCE means then the project must be taken. Okay, and they will make a profit. But ROCE is more than ARR means then you should ignore that project or look for another opportunity. Did you understand that?
Yeah, understood that.
So when you're writing theory, you have to know this. Okay.
Okay.
Okay, so let me explain weighted average cost of capital. Okay, so it represents the average rate that a company expects to pay to finance its business. Okay, so to run a business, they need money. So they have to take lots of money from banks like that. Okay, so the average rate that the company expects to pay to finance its business is known as that weighted average cost of capital. Okay, did you understand that?
Yeah, understood that.
Okay, so it is calculated by multiplying the cost of each capital source, that is debt and equity. Okay, so when we are like doing questions, you will know, but then for your own knowledge, I just gave you those notes. Okay, and
Okay.
then just
Okay.
remember that if weighted average cost of capital is lower, means it's better. Okay, and if that value is lower, then it's less risk for the company. Okay. And then
All right.
profitability index is the measure of ratios between the present value of future cash flow and the initial investment. So if you want to find profitability index, then the present value of future cash flow, we have to divide it by the initial investment. Okay. And then you have to give the answer as is to 1. Okay. The answer is to 1. Okay. And then you have to know in profitability index, if it's greater than 1, if the value is greater than 1, the project the project generates value and the company may want to proceed with the project. Okay, so if the profitability index is greater than 1, then the project will generate lots of profits for the company, and they will want to proceed with the project. But if the profitability index is less than 1, the project will not make a profit and they should not proceed with that project. Okay. But then if the profitability index is equal to 1, the project breaks even and the company is indifferent between proceeding or not proceeding with the project. Because no point in taking a project if they are not making a difference, right?
Yeah.
Okay, so like that you have to know in profitability index. Okay, so if the profitability index is higher, then it will be more attractive for the investment to take place. So if it's higher, it's better. Okay.
Okay.
And also another thing that you have to know in WACC is that WACC is used by investors to determine whether an investment is worthwhile. Okay, so it will help the investors to identify whether the investment is worthwhile or not based on that WACC value. Did you understand that?
Yeah, understood that.
Okay, so far do you have any doubts?
No, not really.
Okay. So in Jan 2020 past paper, first question, they are saying you, okay, so I'll explain the question roughly, okay. They are saying they are going to purchase 10 new electric delivery vehicle to replace older diesel delivery vehicle. That means they are going to sell the old one and buy a new one. Did you understand that?
Yeah, understood
So
that.
they are going to sell older diesel delivery vehicle and they are going to purchase 10 new electric delivery vehicle. Okay. So that is what they are going to do. So they have all the initial cost involved. Okay. So the cost in this question, what's the cost of the project? Do you know the cost of
600,000 pounds.
in this question? Do you know the cost of the project?
Yeah, it's 600,000 pounds. The
Yeah.
investment.
Yeah, correct. Okay, so they have given the cost of the project and then they have given all the cash inflows and outflows. Okay, so tell me the cash inflows in this question. Just roughly, what are the cash inflows?
Uh, the delivery charge would be one inflow.
Delivery charge?
Yeah, the delivery, the price,
Yeah, yeah. Okay, what else?
so that also the selling price of the vehicles at the last day of day 5, last day of year 5.
Okay, so cash outflows will be the rest.
Sorry, I can't hear you.
Okay, what are the cash outflows then?
So, mm, one outflow would be the cost, and the other outflow will be the depreciation,
Okay,
mm,
correct.
also the driver's salary.
Okay, okay, correct. So in this question, do you have any doubts to ask in this, like the question part?
No, not in the question part.
Okay. Okay. So in for A part, they're telling you to calculate the net cash flow for each of the 5 years of the project. So how to find net cash flow? Cash inflows minus cash outflows will give you net cash flow, right?
Yeah.
Okay. So like that we have to find. So let me explain you how to do this. So year one, they are saying each delivery vehicle will make 50 deliveries per day. So deliveries per day, in that column you can write it as 50, right?
Yeah.
Okay, so look at my whiteboard. So in both year, okay. So now, wait. First we'll write all the deliveries per day. Okay. So in both year 2 and year 3, each delivery vehicle will make 65 deliveries per day. So year 2 and year 3, we can put 65. Did you understand that part?
Yeah, understood that part.
Okay. So look at year 4 and 5. So in both year 4 and 5, each delivery will make 80 deliveries per day. So year 4, we can put 80 and year 5 also 80. Now customer charges per delivery. Okay, so each delivery customers 2.50 per delivery. So how to find the customer charges? You tell me how to find that.
Uh, since it's 50 deliveries per day, that
Okay.
will be 50 into 6 and that into 50.
Why 6?
Because vehicles operate for 6 days a week.
No, not like that. Okay. But you have to find that in this part, total cash inflow. We are finding only the
Ah,
customer charges per delivery. So it's 50 into 2.50. Did you understand?
yeah, okay.
Okay. So 50 into 2.50. So how much is 50 into 2.50?
125.
Yeah. Okay. So we'll put 125. And then can you do the rest for all these? It's easy right now. Year 2 and
Yeah,
3. Okay.
yeah,
So
okay.
do that and tell me. So now just tell me how will you find total cash inflows now? So if it's wrong, I'll tell you the answer. But then I want you to know, like, how will you find total cash inflows now?
So that the first year is going to be 125 into 6 into 50.
You missed one value. Okay. You have to multiply that answer by 10 because they are purchasing 10 new electric vehicles, right?
Right, yeah.
Okay. So it's 6 means into, okay, 125 into 6 because it's 6 days per week. And then 50 weeks a year. So 125 into 6 into 50 into 10 because they are purchasing 10 new delivery vehicles. Did you understand?
Yeah, I understood.
Okay, because in this question they are giving the values only each delivery vehicle. So read the question in year one, each delivery vehicle. So the question is this question is based on each delivery vehicle of vehicles only. So at last you have to multiply by 10 in order to get the total value for all those 10 electric vehicles. Okay.
Okay.
Okay. So calculate that answer and tell me the value. So 50 here it's 840, right?
Yeah, 50 is 840.
But then it's wrong. Okay, all second year is correct. Your second year is correct. Third year is correct. Fourth year is correct. First year is also correct. Fifth year it's wrong because look at the
Yeah.
question. Okay, on the
We
last,
have to add the 50,000.
yeah, because you know that's the sale value, right? The scrap value, right? Okay, so on the last day of year 5, all the delivery vehicles will be sold for a total of 50,000. So that 50,000 is also cash inflow, right? Because by selling that vehicle, we are getting cash. Did you understand?
Yeah,
So we have to add that 50,000. So 840,000 plus 50,000 will give you 890,000. Did you understand that?
yeah, I understood.
So in total cash inflows, you can put 280 into 6 into 50 into 10, which will give you 840,000. And then again, you have to show 840,000 plus 50,000 equals 890,000. Like that, you have to write. Okay.
Okay.
So in this question, okay, now we'll find the total cash outflows. So how to find is, now we have to find the driver's charges. Okay, so we are going to pay the drivers, right? So they are saying in all years 1 to 5, drivers will be paid 0.50 pounds per delivery. Okay, so in year 1, there is 50 deliveries, right? So 50 into 0.5. And in year 2, it's 65. Year 2 and 3. So it's 65 into 0.5. Did you understand?
Yeah, I understood that.
And like that. And in year 4 and 5, it's 80. So 80 into 0.5. So find that answer and tell me.
Okay.